Greetings and welcome to Chapter 13 of our look through the Walker textbook. And this is the chapter where we look at stocks. And basically, we're in the midst of mutual funds, then stocks, then bonds, then real estate. So essentially, the four major investment vehicles as we look at long-term investing. So we're going to just kind of give you a brief overview of what stocks are in this chapter. And you're already seeing that a little bit with your stock project. All a stock is that when you buy a stock, you're a part owner of a company. And so if the company makes profits, you get part of the profit. You benefit from that. We call that a dividend, which is your percentage of the profits. The other way you make money off of stocks, and here's the primary way people make money off of stocks, is they buy and sell them. So you buy a stock, hopefully at a low price, and you've spent money on it, right? Just like you've done with your stock project. Let's say you buy a $100 stock. That means you've spent $100. In exchange, you get a stock certificate. You're $100 in the hole at the moment, but then when you sell the stock, let's say the price has gone up to $130 because the company is profitable, people want to buy a part of it, so you sell the stock for $130, and voila, you have made $30 profit. So, because you get $130 at the end, the $100 you originally spent plus the $30 profit you made. Obviously, if the stock price goes down, you can lose money as well. And so when we're talking about stocks, we're generally talking about publicly held corporations. There are some corporations that are privately held where there's a very limited number of stockholders. But a publicly held corporation, their stocks are traded openly on a stock exchange. So anybody in the public, hence the name publicly held, can buy and sell. Oftentimes in economics, when we use the term public, we mean government. This is not the case. Here, it just means that anybody in the general public can buy or sell a stock. So there's two types of stock, a common stock and a preferred stock. And common stock is basically the main type of stock. You're a voter in the company. You're an owner of the company if you own either type of stock, but you have voting rights. You get treated essentially as if you're a part owner of the company, and you will get dividends as well, which is a portion of the profits. Preferred stockholders actually forfeit their voting rights. They don't get to vote for the board of directors, but in return for giving up their voting rights, they also get the first cut of the dividends. Preferred stocks have a tendency to be a little bit steadier and less volatile in their stock prices than common stocks. If a company declares bankruptcy, the preferred stockholders are going to get paid first and get some dividends out of the remaining assets of the company. And then the common stockholders, they get the last cut. So if there's anything left over, maybe they get a little bit of something there. A word you'll hear a little bit when we talk about stocks is the IPO, or the initial public offering. That's when the company first sells its stock. It will often set the price of the IPO, and after that, it's bought and sold in the open market, and thus market prices determine how much stocks cost. So you buy stocks and sell stocks on an exchange. The largest and most notable in the United States is the New York Stock Exchange. It's been around since 1792. And there, transactions are conducted on a trading floor with brokers shouting out prices to find buyers and sellers. There's also electronic trading on the New York Stock Exchange, and most stocks today are traded electronically, which means when you decide you want to buy a stock, you send a note to your broker. Your broker will electronically find a seller for you. You'll agree on a price electronically, and then the sale will be made. Back in the day, and still they do this in the floor of the New York Stock Exchange, you would call a broker, they would make a phone call to the floor of the stock exchange and say you wanted to buy 10 shares of Apple at a certain price. Well, somebody would run around yelling, Apple, Apple, and trying to find somebody to sell 10 shares of Apple at that price. And so that's how things were. Today, they're pretty much done electronically, although there is some transaction activity on the trading floor. NASDAQ primarily is technical stocks, and that's fully electronic. It's done over a computer network. NYSE Market also used to be known as the American Stock Exchange. That's a smaller stock exchange, features mostly smaller companies. The largest companies and the most prestigious companies are all traded on the New York Stock Exchange, and primarily technical stocks, computer type stocks, technology companies are traded on NASDAQ. A lot of smaller companies as well are traded over the counter, which means they're not traded on a formal exchange. There are also foreign exchanges. Most countries have their own stock exchanges as well. How do we evaluate a stock? What sets the stock price? Supply and demand, just like everything else. One of the first things we learned during the semester was that prices are so set by supply and demand. That's one of the first things we learned during first semester. If you don't learn anything else in economics, learn that. Prices are set by the junction of supply and demand. And nowhere is that more obvious than the stock market, because you have millions of transactions happening every day with buyers and sellers trying to find the perfect price. And again, price is that compromise between the seller who wants the highest possible price and the buyer who wants the lowest. And so what prices do people buy stocks at? Well, we're buying them based on the expectation of future earnings, data from past performance, and things like that. So stock prices tend to be forward-looking. We're looking at how we think the company is going to do in the future. We're basically betting on what we think the company is going to do in the future. If you think the company is going to do well in the future, you want to buy it now because you're expecting the stock price to go up. If you think the company is going to do poorly in the future, you want to sell it now because you think that stock price is going to go down. There is a market hypothesis that we hear about a lot. You hear a lot of people, they're looking for bargains in the stock market. Well, the efficient market hypothesis basically states that stock prices really don't yield a lot of bargains because most stocks are properly priced. You don't find too many that are priced too low. You don't find many that are priced too high. Usually they're in the middle because buyers have an abundance of information. Sellers have an abundance of information that is available to them. On a bull market, if you hear things about bulls and bears, bull markets just basically mean stock prices are going up. Bear markets generally mean stock prices are going down. And that's a general trend. Generally, you'll hear, hey, the bulls are out today. That just means people are buying stocks and the stock market's going up. Or somebody has a very bearish outlook. That just basically means they expect the stock market to go down. So how do we measure the stock market? There are a few indices. And the index is the number representing the value of a slice of the stock market. We really can't look at the entire market, but what we can do is look at a slice of the market. So the Dow Jones Industrial Average, or the Dow, is generally the proxy for the health of the stock market. It's often seen as a proxy for the health of the economy as well. And that's just 30 large, well-known stocks chosen by the editors of the Wall Street Journal. It's been around for well over 100 years, and it's generally used as a representation of the whole stock market. If you want to know how the Dow is calculated, look at page 333 in your textbook. It does a really good job of it. It adds up the stock prices and then divides by the number of stocks, and you have a little bit of a mathematical factor involved in that, because obviously some stocks are worth more than others, some stocks split and things like that. The S&P 500 is a little more broad-based. It's 500 large company stocks. It's been around for about 60 years, and because it's a little bit more broad-based, it's probably a better indicator of how the stock market is, but generally the Dow is used as your primary indicator for not just the stock market, but a lot of times the overall macroeconomic vision of how the economy is doing. We also hear the NASDAQ composite, which is 100 primarily technology stocks that are bought and sold on the NASDAQ exchange. And so whenever you hear the stock report on the radio or the TV at the end of the afternoon, these are generally the three that are quoted. Hey, the Dow's up 100 points today. The S&P's up 50. The NASDAQ is up 10. And that just tells you that all three stock indices are going up. Now, when you look at a stock quote, and we've done this already, what are you looking for? Kind of a few things. Number one, the price of the stock. And obviously, that's how much it's going to cost. So the price you'll see a few things. Open, which is the price at the start of the day, close is the price at the end of the day. The low and the high are the lowest and highest prices. So you have a pretty good idea of what the range the stock is trading at, what the range of prices are. You can also look at the week's high. There's often a 52-week low and high, so you can see the lowest and highest prices over the past year. You can also look at the dividend, which are the profits distributed to shareholders. Those are usually paid quarterly. And the yield, which is dividends per share divided by the stock price. One other thing I really like to look at is the price to earnings ratio, which is the stock price per share divided by the earnings per share, which is how much money per share the company earned in the last quarter. If the PE ratio is high, that shows that you've got a high stock price and kind of a low earnings per share at the moment. So we're expecting the company's earnings to go up. If the ratio is low, that means we're not expecting the earnings to go up much. The stock price is fairly low compared to the earnings. And so when you're looking at value stocks, those are stocks with really low price to earnings ratios, which basically is anything below 10. And so you're looking at, hey, these stocks are really, really cheap right now because the company probably isn't going to grow a whole lot in terms of its earnings, but the price is really low. So the ratio between the price and the amount of money the company is earning right now is really low. So the reality is that's probably a bargain. If you see a really high P/E ratio, that probably means the stock's probably a little bit overpriced. So let's go to Yahoo Finance here and take a look at what a stock will look like here. And I'll pick Apple as my stock here, and you can kind of see on the screen the Dow here. And I tried to pick Apple, and somehow it's gone from $9.55 to $11.20 in the last year. It's gone from 69 cents to 21.75. The price to earnings ratio is not available for this one because its earnings per share is negative. In other words, the company is losing money at the moment. Because of that, there's no dividends. So let's look at Apple real quick and take a quick look at Apple, because I know it does have a dividend. It pays $3.08. So that's your piece of the profits. The yield then is the dividend divided by the stock price. So it's 1.28%. So you know you're going to make a 1.28% return on that. So Apple right now, you see it's going up a little bit, 256.37, and then it drops. This is the price of the last trade. So you can see here's the range. We're pretty much at the top of the day's range the day we'll record this. We're closer to the middle of the 52-week range as well. So, and their price to earnings ratio is 20.36, which means it's not a value stock by any stretch of the imagination. So really quickly, just to wrap up, how do we evaluate a company? How do you decide which stock to buy? Number one, look at their annual report with the SEC, better known as the 10K or the 10Q, which is the quarterly version. Their annual report explains their operations, discloses the risks, and their financial statements. It also will often include reports from the chairman of the board and high-level officials in the company that will tell you how things are going. Every company that is publicly traded must make its annual report public and file it with the SEC. Usually you can find that on the company's website. So you want to look here at the current ratio, which is assets divided by liabilities in the short term, as well as the debt ratio, which is the long term. If that's really high, you've got high debts divided by high assets, that basically means this company is really struggling because they've got a lot of debt. Times interest earned ratio. If this is high, which is your earnings before interest divided by your interest payments, if that's really high, that basically means the company's in good shape. So, you can use this to compare companies within the same industry. And so that's one thing you want to do. Now, how do you buy and sell a stock? Call Edward Jones, call Charles Schwab, go to E-Trade. There's a lot of places you can do so, but there's essentially two types of brokers. There's full service brokers. They're going to cost a little bit more, but they're going to give you more personal advice. Discount brokers are kind of like some of the internet brokers. They will execute trades on your behalf, but they're not going to provide advice, but obviously going to be a little bit cheaper. As far as types of trades, you're going to look at this in your book. Probably the one you need to know is the market order, which is buying at the stock price. So generally market orders are 100 at a time. So let's say you want to buy 100 shares of Codynamics, which is what, $20. Okay, you're just spent $2,000 buying those shares. There's a bunch of other types of trades you can make, and that's a little bit obscure. So let's just leave it at the market order and keep it simple. Now, investment clubs are kind of like mutual funds. The key thing here with an investment club is it's going to, like a mutual fund, give you diversification. As a investor, you don't want to purchase individual stocks unless you're already diversified. An investment club allows you to do so by contributing a set amount of money in the investment club's account. And generally, people maybe will take turns studying companies as well. As far as buying stock directly, sometimes you can use a direct stock plan, which the company will automatically purchase stock, usually in the company you work for you. The DRIP plan is also known as the dividend reinvestment plan, which basically states that when you get dividends, it'll just reinvest your dividends back in the stock, so you end up buying more and more of the stock. You can also buy single shares, which allows you to start a DRIP plan as well. So that's kind of a way of doing so. So essentially, again, go back to the main basics here. Stocks are generally an investment in the company. You're buying ownership in the company. And because of that, you want to be diversified as much as you can. Buy as many different types of companies as you can. And also, you want to buy at a low price whenever possible and sell at a high price whenever possible. And it's very difficult to know when to do those things because timing the market is very difficult. So generally what we want to do, and this is a vocab term from the past, is dollar cost averaging. You want to buy your stocks over time and buy your investments over time. Most of us, our stock market exposure is going to be through our mutual funds and through our 401ks and our retirement plans, and that's perfectly fine. I really don't recommend a whole lot of people individually invest in stocks because most of us just simply don't have the knowledge to do so and don't have the capital to do so. Do it in mutual funds instead, where you've got a fund manager who knows what they're doing and who's going to be able to give you that diversification that you need. And so if you want to dip your toes in the stock market, only do so if you're able to take on some of the risk. But at least you have an idea now what the stock market is, how it works, and obviously your stock project is allowing you to do that just a little bit more. So thanks for joining us on this. Obviously, if you have any questions, hop on the forum or one of our chats, and we'll address those, or you can do so through a short email to me. So thanks a lot, and enjoy the class.